Hello students, welcome to today's mentoring session which is on paper 1 financial reporting, and today's topic is in continuation to the topic major differences in Ind AS vis-a-vis existing notified accounting standards. Today we are going to cover our first Ind AS, which is on. Before starting, let me introduce myself. I am CA Shilpa Agrawal, accounting faculty.
I am CA Seema Gupta.
And today we'll be taking your mentoring session. Before starting, let's move on to the. We would like you to note for following disclaimer slides. Students are advised to refer to the study material, including supplementary study material, if any, and other relevant legislation for latest provisions, amendments required for forthcoming examination. Students are advised to refer to e-lectures available on the students' LMS for this and other topics. These lectures are freely accessible. You have to just register with your student registration number and start learning immediately. Before starting with today's Indian accounting standards and their differences with vis-a-vis existing notified standards, let us first have a look on how many topics which we have, new topics which have been included for May 16 examination, and we have covered a mentoring session for those new topics. In January, we have taken 2 mentoring sessions, which was on accounting and reporting of financial instruments. This is not a new topic, but since earlier we were studying this topic on the basis of existing AS 30, 31 and 32, now a modification has been made, according to which now you have to study accounting and reporting of financial instruments based on Ind AS 32, 107 and 109. So this is completely a new chapter, and based on that new chapter, a supplementary material has also been released, and we have taken 2 mentoring sessions in continuation to one to other, that is on accounting and reporting of financial instruments. Later on, at the end of January, we have started mentoring session on Indian accounting standard. First mentoring session was roadmap and carve-outs in Ind AS from IFRS. Then in February, we have taken 2 mentoring sessions. The first mentoring session in the February, which was on 17th February, was on we have covered Ind AS 1 and Ind AS 2 and their respective differences with their respective notified existing accounting standards. On 25th February, we have covered Ind AS 7, Ind AS 8 and Ind AS 10. So till February, we have covered 5 Ind AS. In the month of March till now, we have already taken 2 mentoring sessions. On 12th March, we have taken Ind AS 12 vis-a-vis notified AS 22 and Ind AS 16. On 16th March, we have taken Ind AS 17 and Ind AS 19 and their differences vis-a-vis the respective notified standards, existing accounting standards. Today, we are going to cover 3 standards based on the availability of time. That is on Ind AS 20, Ind AS 21 and Ind AS 23. So let's start with today's Indian accounting standards. Today, our Indian accounting standard is Ind AS 20, accounting for government grants and disclosure of government assistance. This is the name of Ind AS 20, and the comparison has been made with notified AS 12, which is accounting for government grants. So from the name itself, you can understand that notified AS 12 is only for accounting for government grants. However, Ind AS 20 is for accounting for government grants and disclosure of government assistance. So from this name only we can understand, we can draw certain differences. Differences shall be based on government assistance. What are government assistance? Disclosure of government assistance, since it is accounting for government grants only, not for accounting for government assistance. So the standard very clearly mentions that government grants are to be accounted, but government assistance are not to be accounted. They have to only be disclosed. So for disclosure, what is government assistance? This is the first difference we can understand. We can very well perceive that this will be our first difference. So the definition part, because AS12 are notified or existing AS12 does not talk about government assistance, so we do not have any definition on government assistance. However, in Ind AS 20, there is a concept of disclosure of government assistance. It means we'll be having a definition of government assistance. What is government assistance? So Ind AS 20 states that government assistance is action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. So, government assistance for the purpose of this standard does not include benefits provided indirectly through actions affecting general trading conditions. So, first thing which we can understand from government assistance is that they are the action by the government. They are not any monetary grant. They are just an action taken by the government. And that action taken by the government is designed to provide some economic benefit to any economic benefit to an entity or range of entities qualifying for that certain assistance. So assistance does not include benefits provided indirectly for trading purposes or trading conditions, but the benefits which are provided, which is other than for trading conditions. Government assistance exclude from the definition of government grant. So government grant does not include government assistance. The definition of government grant as per Ind AS 20 states that it excludes those grants which cannot reasonably have a value placed upon them. Therefore, it is again said government assistance are only action taken by government, not something which is in monetary terms. So which does not have any value placed upon them. And there are two things in assistance. Second is transactions with government which cannot be distinguished from the normal trading transactions of the entity. So now let me give you some examples of those actions taken by government on which we cannot place any value. For example, free technical or marketing advice given by government, or provisions of guarantees. You have taken any loan, and for that loan, government has become a guarantor to your loan. So that guarantee which is given is an action taken by the government, not in the form of any amount money they are supporting you, but by their action they are supporting you. So this is also a government assistance. Now, second part, as I already told you, assistance carries two things. One, that in which some action of government on which you cannot place the value, and another thing is which cannot be distinguished from the transactions with government, which cannot be distinguished from the normal trading transactions of the entity. That will also be considered as government assistance. Now, what is some transaction with government which cannot be distinguished from the normal trading transaction? Example is a government procurement policy that is responsible for a portion of the entity's sale. For example, further let me tell you what is government policy. Let me give you an example of government procurement policy. Suppose government is specifying that for particular entity government will be buying certain amount of whatever their products are, whatever their stock is. For example, arms and emissions. From that, government has specified that 50% of whatever you are manufacturing will be bought by government only. So this is government procurement policy. This is an assured sale for that entity. So for that entity, it's a trading transaction. They are selling it to the government. They cannot distinguish it from the normal trading transaction. But since it is the government policy and they have assured you, so it is an assured sale. When it is an assured sale, it is in the form of assistance. So we cannot distinguish that transaction with the government from the normal trading transactions of the entity. That such type of transactions are also considered as government assistance, and that government assistance is disclosed in the financial statements of an entity who is getting such assistance from the government. So Ind AS 20 deals with other forms of government assistance which do not fall within the definition of government grants. However, this distinction is not made in AS 12. It requires that an indication of other forms of government assistance from which the entity has directly benefited should be disclosed in the financial statement. So Ind AS 20 also deals with disclosure of such government assistance which has a direct benefit, which has been directly benefited, entity which has been directly benefited through those government assistance. The second difference is grant in respect of non-depreciable assets. As we already know that AS 12 requires that the grant in respect of non-depreciable assets should be shown as capital reserve, which is part of shareholders fund. So when you are getting a grant in respect of non-depreciable asset, your entry will be bank account DR to capital reserve. And what is shareholders fund? Shareholders fund is capital plus reserves in surplus. So since it is a reserve, so it will be part of shareholders fund. If a grant is related to a non-depreciable asset that requires the fulfillment of certain obligations, when certain obligations may arise because of receiving grant for non-depreciable asset, it means an entity has to spend something in future, maybe in the current year, maybe in the future years. So it becomes an obligation for an entity. So in such a case, those grants, instead of being treated as capital reserve, they are treated as deferred income. So in place of that here crediting capital reserve, what account will be credited as deferred grant account. In deferred government grant account, and whenever we are spending that obligation, we are discharging that obligation, at that time proportionately the grant will also be charged to P&L account. The grant should be credited to income over the same period over which the cost of meeting such obligations is charged to income. Alternatively, such grants can be deducted from cost of such asset in case it is a non-depreciable asset, but it's an asset for, you can, instead of creating deferred grant account, you can, third option is that, sorry, it's not a third option. Instead of deferred grant account, second option is to reduce the cost of the asset. So your entry will be bank account DR to asset account. What is the treatment as per Ind AS? This is the treatment which is given in AS 12. Now what is the treatment as per Ind AS 20? Ind AS 20 says nothing is in the nature of whatever the grant which is given by the government, that is always attached with certain obligations. And when there is certain obligation, then no question arises to transfer it to reserve. So it means they say there is no option to treat it as shareholders fund or to transfer it to or treat it as capital reserve. You have to recognize it as income over the periods which bear the cost of meeting the obligation. So it therefore specifically prohibits recognition of grants directly in the shareholders fund. So what implies here is that as per Ind AS 20, such grants in respect of non-depreciable assets will always be, entry will always be bank account DR to deferred government grant account. Here, one thing which you maybe notice that Ind AS 20 does not say to reduce it from the cost of the asset. It only says that you have to recognize it as income over the periods. Now let us see. I think we have certain queries on the standard. On these, if it is on these two differences, we may take it up. Otherwise, let me complete the standard. So, a third difference is government grants in the nature of promoters' contribution. First, we have studied government grants in the nature of for non-depreciable assets. The treatment which is given for government grants for non-depreciable assets is similar to the treatment which is in AS12. What is the treatment which is given to the government grants for non-depreciable assets? The same treatment is given to the government grants which are in the nature of promoters' contribution. So, accordingly, grants which are similar to those of promoters' contribution should be credited directly to capital reserve and are treated as part of shareholders' fund. However, again, the same concept applies. Ind AS 20 does not recognize government grants in the natures of promoters. Nothing is there for Ind AS 20 which is in the nature of promoters' fund. They do not say no grant is in the nature of Ind AS 20 states that no grant is in the nature of promoters' contribution. So it implies that they cannot be transferred to shareholders' fund. They cannot be treated as capital reserve. So they have to be recognized as income over the period. So again, in case of such type of grants, which as per AS 12 is in the nature of promoters' contribution, when it will come to Ind AS 20, we have to recognize it in income over the period. So entry will be again bank account DR to deferred government grant account. And the reason is Ind AS 20 is based on the principle that all government grants would normally have certain obligations attached to it. And when there are certain obligations, so those obligations, when are discharged by entity, they have to recognize it in the profit and loss account. So obligations are related to those grants, so those grants should also be recognized in profit and loss account as income. So based on that principle, Ind AS 20 states that any grant which is received by the government for non-depreciable asset has to be recognized as income because certain obligations are attached to it, and for those obligations has to be recognized in profit and loss account. So the grant should also be recognized as income in the profit and loss account. Four differences for valuation of non-monetary grants given free or at concessional rate. As per AS 12, government grant in the form of non-monetary assets given at concessional rate. What is non-monetary asset? Something which is not given in the form of money, something which is given in the form of assets or in the form of consideration. That if given at concessional rate, then AS 12 states that has to be recognized on the basis of acquisition cost. That means if you are getting something at concessional rate, so if something which is costing ₹100, you are getting from government at the rate of ₹60, so you have to recognize that asset in the books at ₹60 only. If you are getting it free of cost from the government, then you have to recognize it at nominal value. ₹100 asset which is received from the government in the form of grant, then you have to recognize it in the form of say ₹1. That is the nominal value. However, Ind AS 20 requires to value non-monetary grants whether received at concessional rate or whether received at free of cost at their fair value. So non-monetary grant whether received at concessional rate or free of cost are to be recognized at fair value, irrespective of non-monetary grants received at concessional rate or free of cost. As per Ind AS 20, they have to be recognized at fair value. Ind AS 20 states that this is because of the presentation of such assets or presentation of financial statement will be more relevant. Ind AS 20 requires to value non-monetary grants at their fair value since it results into presentation of more relevant information and is conceptually superior as compared to valuation at nominal value. Asset is having a value which is more than a nominal value, but because since we have received at free of cost, it does not mean that the benefit which we are going to achieve or which we are going to receive from those assets will nominal. So it is required as per AS 20 to recognize such assets, though received at free of cost or at concessional rate, you have to recognize it at fair value. So this is the difference between AS 12 and Ind AS 20. Next difference is accounting for grants related to assets including non-monetary grants. Existing AS 12 gives an option to present the grants related to assets including non-monetary grants at fair value in the balance sheet, either by setting up the grant as deferred income or by deducting the grant from the gross value of assets. So we have two options. If we are receiving grants related to non-monetary, we are receiving grants which are in the form of assets, which are non-monetary grants, then we can either create it as deferred income or we can reduce the value of grant from the cost of the asset. Concern in arriving at its book value. However, Ind AS 20 says that you have to recognize or requires presentation of such grants in the balance sheet only by setting the grant as deferred income. Thus, the option to present such grants by deduction of the grant from the cost of the asset in arriving at its book value is not available in Ind AS 20. So only the details. So here it is, we cannot say it's a difference. It's that we have Ind AS 20 is prescribing only one condition, and that is creation as a deferred income. They do not allow you this option, that is to reduce it from the cost of asset. Government assistance. Ind AS 20 includes Appendix A, which deals with government assistance. Government assistance, as we have already explained you, something which is in the action of government and not in the form of money. We cannot place any value to it, which is not enough. Though it's a sometimes non-monetary assets are also in the form of government grants because we can place value to it. However, such certain actions of the government on which we cannot place some value, they are government assistance. So a guide appendix is there in Ind AS 20, which which clarifies the accounting treatment when government assistance should be classified as grant and should be accounted, and when it should be treated as only assistance and not to be accounted. No specific relation to operating activities. Any government assistance which is not specifically related to operating activity, then what will be the treatment? What is the accounting principle for such government assistance is mentioned in Appendix A. However, AS 12 does not talk about government assistance, so no such guidance is given in AS 12. The last difference in Ind AS 20 is regarding loans at concessional rate. As we have told you, as government grants can be for non-monetary assets, government grants can be at concessional rate also. So in case of concessional rate, accounting treatment as per Ind AS 20 is that we have to recognize and measure such items or such loans in accordance with Ind AS 109. If we are receiving certain loans from government which are at concessional rate, though that is a loan which is a government grant for you, but for a recognition part, but for measurement part, we have to refer Ind AS 109. We have to refer Ind AS 109. Ind AS 20 requires that loans received from a government that have a below market rate of interest should be recognized and measured in accordance with Ind AS 109, because Ind AS 109 requires all loans to be recognized at fair value, thus requiring interest to be imputed to loans with a below market rate of interest. So, though we are receiving a grant from loan from government which is at concessional rate, so it is not that we have earlier also seen anything received from any grant received from government at concessional rate, there has to be recorded at fair value, and that recognition at fair value in case of loan we have to refer Ind AS 109, because Ind AS 109 also talks about fair value, recognition of all loans at fair value. So let us move on to here. These are the differences between Ind AS 20 and notified AS 12. Let's move on to the query. First query is by Shivang Mafatia. Can a practical question be asked in exam based on Ind AS, carve-in, carve-outs, and on Ind AS? So students, since this topic is really a theoretical topic, we are asking you, the topic covers the summaries of all Ind AS, differences in Ind AS vis-a-vis existing accounting standards, and carve-outs in Ind AS vis-a-vis vis-a-vis IFRS. So these are all conceptual things, theoretical portion. There also we are advising you to focus mainly on differences and carve-outs. So in our opinion, we feel theoretical question will be is expected in the examination, and practical questions, it is rare chance a question will be asked on practical question. In my opinion, I don't think question will be practical question, any practical question will be asked on this topic. Theoretical chances are for theoretical questions only, but this is my opinion.
Manoj Santani have asked that whether we should write difference of Ind AS in T form or in para form. It hardly matters whether you write in T form or in para form, but the content of the differences given in the answer, that they should be correct. If the answer is correct, it hardly matters whatever way you are presenting. No mark should be deducted for that presentation part. Now let us move to the PPT. Now, after discussing the difference between Ind AS 20 and AS 12, now let us move to Ind AS 21, the effects of changes in foreign exchange rates vis-a-vis notified AS 11, the effect of changes in foreign exchange rates. So, these two standards basically deal with the changes in foreign exchange rates and how to account for them in our financial statements. First difference is about forward exchange contracts and other similar financial instruments. Now, what is forward exchange contract? As we have already discussed in our earlier mentoring session, which we took for financial instruments, at length we discussed about the forward exchange contracts. It's an agreement. The forward exchange contract is an agreement between two parties giving the buyer an option to purchase an asset and the seller an option to sell the asset at a particular future date at a fixed price. So these type of forward exchange contracts and such similar financial instruments are not included in our AS 11, but in AS 21, these in AS 21 exclude from its scope all these type of forward exchange contracts, and existing AS 11 does not exclude accounting for such contracts. So this is a major difference. As AS 11 covers accounting for the forward exchange contracts, it gives a guidelines regarding it, but Ind AS does not give any such clarification, any such accounting treatments for these type of specific contracts, because it these forward exchange contracts under financial instruments. So the relevant Ind AS will be dealing with these financial instruments. Ind AS 21 talks about presentation currency. This is a new term which we have not read under the existing notified AS 11. We only discussed about reporting currency and foreign currency in our existing AS 11. So we are not familiar with the term presentation currency. It's a very general term. If we see it specifically, it's the currency. It's the currency which we are using for presentation of our financial statements. So Ind AS denotes it as presentation currency. The currency in which the financial statements are presented is presentation currency. There are three types of currency which are dealt under Ind AS 21: presentation currency, foreign currency, and functional currency. So presentation currency, we are thorough with it. It's a currency in which our financial statements are presented. A currency other than the functional currency of the entity is known as foreign currency. And what is functional currency? The currency of the primary economic environment in which our entity is operating. That is basically functional currency. So we have three types of currency: functional, presentation, and foreign. These three types of currencies asked per Ind AS 21. But our existing AS 11 only talks about two types of currency. One is reporting currency and the other one is foreign currency. And we are very familiar with those terms as they have been clearly mentioned. They have been defined in terms mentioned in AS 11. An entity may present its financial statements in any other currency if the as per Ind AS 21, if the presentation currency differs from the entity's functional currency, it translates its results and financial position into the presentation currency. For example, when a group contains individual entities with different functional currencies, the results and financial position of each entity are expressed in one common currency so that the consolidated financial statements may be presented. So basically the terminology may be different, but more or less, if we see the presentation part of the currency, in understanding part of the currencies and uses of it are more or less same in both the standards. This was the second difference. Now let us move to the third difference: approach for translation. The existing AS 11 is based on integral foreign operations and non-integral foreign operations, IFO and NFO. Integral foreign operation is basically the operation, the activities, operations of which are integral to a business entity, and non-integral foreign operation is the one whose operations are not integral to our business activities, of which are not integral part of our reporting enterprise. So this is this terminology of integral foreign operation and non-integral foreign operation is described under existing AS 11, which is notified. Now under proposed Ind AS 21 under notified Ind AS 21, the approach for translation is basically functional currency approach. It's not as per integral foreign operation or non-integral foreign operation. It is based on functional currency approach. So now what is functional currency approach? We will discuss it also. Functional currency is a currency of the primary economic environment. It's the currency of the primary economic environment in which the entity operates. The primary economic environment in which entity operates is normally the one in which it primarily generates and expends cash. An entity generally considers what type of factors in determining its functional currency. The very important factor is the currency which mainly influences sale price of the goods and services, and the currency of the country whose competitive forces and regulations mainly determine the sale price of the goods and services. The second important factor while determining the functional currency is the currency that mainly influences labor, material, and other costs for providing goods and services. So this is a major source for any business entity. It has to pay cash for various services, like it has to pay money for supply of materials. It has to pay salaries and wages to the labor. So the determination of the currency factor is determined by these factors. This will often be the currency in which such costs are settled and the way in which these costs are denominated. The currency in which receipts from operating activities are retained, and the currency in which funds from financing activities, that is, issuing debt and equity instruments, are generated. So these four factors: one is the currency which mainly influences your sale price. Number two, the currency which mainly influences your cost part, that is labor cost or direct material cost or any other services you are incurring and paying for it. Third, the currency in which funds from financing activities are generated. Number four, the currency in which receipts from operating activities are retained, either by way of sales or by way of supply of any materials, whatever it is. So these factors determine the which currency will be considered as a functional currency. Now, what will happen if there is a change in functional currency? When there is any change in entity's functional currency, the entity shall apply the translation procedure applicable to the new functional currency prospectively from the date of the change. So whenever you are changing this currency, you have to apply the new functional currency from that date only, not from back, not from retrospective effect. You cannot do any change. So this is a major difference in terminologies between Ind AS 21 vis-a-vis AS 11. In Ind AS 21, the factors to be considered in determining an entity's functional currency are similar to the indicators in existing AS 11 to determine the foreign operation as non-integral foreign operation. So more or less, we can say that only the uses of terms are different. Only the definition of terms may be different, but the intention and the accounting part is more or less same. There is no major difference between both translation procedures under both the standards. Consequently, despite the difference in the term, there are no substantive differences in respect of accounting of a foreign operation under both the standards, Ind AS 21 as well as notified AS 11. Now come to the fourth point, exchange differences arising on. This is the major provision as per Ind AS 21. All the exchange differences arising on the settlement of monetary items or on translating monetary items at rates different from which they were translated at the time of initial recognition. At the time when you first recognize them, during the period or in previous financial statements shall be recognized in profit or loss in the period in which they arise. So at the time when they were initially recognized and at the time when they were arisen. This is regarding exchange differences arising on settlement of monetary items or translation of those monetary items at rate different from those at which they were translated or at which they were recognized earlier. Now, what about non-monetary items? When a gain or loss on a non-monetary item is recognized in other comprehensive income, any exchange component of that gain or loss shall be recognized in OCI, other comprehensive income only, and conversely, when a gain or loss of a non-monetary item is recognized in profit and loss, any exchange or gain component of that amount shall be recognized in profit or loss only. Exchange differences arising on a monetary item that forms part of a reporting entity's net investment in a foreign operation shall be recognized in profit or loss in the separate financial statements of the reporting entity or the individual's financial statements of the foreign operation as whatever will be the appropriate case will be. These were the major provisions of Ind AS 21 regarding accounting for exchange differences of monetary and non-monetary items. Now, this is a fourth point where we are different, where AS 11 is different from Ind AS 21. How? Exchange differences arising on translation of certain long-term monetary items from foreign currency to functional currency. You all know that existing AS 11 gives us an option to recognize exchange differences arising on translation of certain long-term monetary items from foreign currency to functional currency directly in equity to be transferred to profit or loss over the life of the relevant asset or liability if such items are not linked to acquisition of fixed assets. And if these items are related to acquisition of fixed assets, the foreign exchange differences can be recognized as part of the cost of the asset. As per para 46 of AS 11, we all know that all the exchange differences arising on reporting of long-term foreign currency monetary items related to acquisition of a depreciable capital asset can be either added or deducted from cost of the asset and shall be depreciated over the balance life of the asset. We have the option, or it can be accumulated in foreign currency monetary item translation difference account and amortized over balance period of such long-term asset or liability by either giving a debit or giving a suitable credit accordingly. This is a provision as per para 46 of notified AS 11. So this para gives us an option which gives the option to the entity to recognize it as a profit or loss, besides giving the either as profit or loss in the corresponding years, or to deduct the amount of difference from the cost of depreciable fixed asset, either deduction or addition, as the case may be. If it's a foreign exchange loss or a foreign exchange gain, both ways can be possible. But this is very important difference, that Ind AS 21 does not give the entity any such option. We do not have any such option under Ind AS 21. So existing AS 11 gives us more flexibility. It gives us more elaborate accounting treatments, where we are given an option to do alternative way of accountings. But Ind AS 21 restricts us, and it does not give us any option for non-monetary, for differences arising due to long-term non-monetary differences, long-term non-monetary assets. It does not apply to long-term foreign currency monetary items recognized in financial statements before the beginning of first Ind AS financial reporting period as per AS 11. However, as provided in Ind AS 101, this is also very important, that however, as provided in Ind AS 101, any entity, any such entity may continue to apply the accounting policy so opted for such long-term foreign currency monetary item as per previous GAAP. If an entity was applying and had taken the option or has applied the provision of AS 11 to a particular item, then it may continue to apply even if after application of Ind AS 21. This special provision has been provided under Ind AS 101. So this was all the differences regarding Ind AS 21 vis-a-vis notified AS 11. So after completing this particular AS and the corresponding notified AS, we are again moving to the queries, online queries, if any is there. Is functional currency same as reporting currency? Shivang, you are asking whether functional currency is same as reporting currency.
It is possible, yes, functional currency can be, however, different definitions have been given in the standard Ind AS for functional currency and reporting currency. But at places and at times they can be same also. They can be same also, but different definitions have been provided in Ind AS.
As per definition, they are not same. Exactly, they are not same as per definition. And no other queries are appearing. So now let us move to another standard. So after completing the AS 11 vis-a-vis Ind AS 21, now let us move to notified AS 16 borrowing cost vis-a-vis Ind AS 23 borrowing cost. So both the standards deal with the cost related to borrowings and their accounting thereof. The first major difference is about qualifying asset. In AS 23, all of us are very familiar with the term qualifying asset. What is qualifying asset? We all know that qualifying asset is the way what type of asset is being described as qualifying asset under AS 16, and it must take substantial period of time to complete it to be called as qualifying asset. All the cost, all the borrowing costs related to qualifying asset only are covered as borrowing costs under the standard. Now, Ind AS 23 does not require an entity to apply the standard to borrowing cost directly attributable to acquisition, construction, or production of a qualifying asset measured at fair value. For example, a biological asset. So, first of all, we should understand that Ind AS 23 does not require us to apply the same standard Ind AS 23 to borrowing costs which are directly attributable to acquisition, construction, or production of a qualifying asset. As I have already explained what is qualifying asset, the terminology of qualifying asset will remain same, and the same definition of qualifying asset will still be applicable, and it has to be measured at fair value. It does not require, Ind AS 23 does not require this. For example, a biological asset. Now, what is biological asset? All living animals or plants related to agricultural activity and agriculture produce are basically biological assets. However, existing AS 16 does not provide for any such relaxation, because as per our AS 16, the entity is required to apply AS 16 to all the cost related to acquisition, all the borrowing costs related to acquisition, construction, or production of a qualifying asset. But Ind AS 23 does not require an entity to apply the standard. So for all the borrowing cost of all the qualifying assets. Applicability to inventories. So what about the application part of Ind AS 23 to inventories of a particular entity? Ind AS 23 excludes the application of Ind AS 23 excludes the application of this standard to borrowing cost directly attributable to acquisition, construction, or production of inventories. So basically, there are two types of relaxations as we have studied till now. First, we studied that it does not require the application of this standard to borrowing cost, which were attributable to acquisition, construction, or production of qualifying assets. Same way, it says that it also does not require an entity to apply the standard for all the borrowing costs which are directly attributable to the production of inventories also, production or acquisition of inventories also, that are manufactured or otherwise produced in large quantities on a repetitive basis. So if the inventories are produced on a large quantity basis, on a wholesale basis, and it's a very repetitive feature that generally we are engrossed in such type of production of large size inventories, then it excludes the application of the standard to such type of inventories. But however, if the inventories are manufactured in small quantities, or if these type of productions are not on a repetitive basis, once in a while or once in a span of 2-3 years, we are involved in such type of heavy production of large size inventories, then definitely Ind AS 23 will be applicable, and no exemption will be granted to us. Whereas existing AS 16 does not provide for any such scope relaxation. It is basically a scope relaxation which is being provided by Ind AS 23. However, existing AS 16 does not provide for any such relaxation and is applicable to all the borrowing costs related to all inventories if they require substantial period of time to bring them into sellable condition. So this is a major difference between Ind AS 23 and notified AS 16. Now come to the third point, inclusion as borrowing cost. As per existing AS 16, borrowing cost into what does borrowing cost include as per existing AS 16? Now, this is just revision of the definition of borrowing cost as given under existing AS 16. Interest and commitment charges on bank borrowings and other short-term and long-term borrowings. First point, amortization of discount or premium relating to borrowings. If any discount, if the company has issued debentures and there is a discount on debentures, or maybe some premium you have to pay on redemption of debentures. So this is you have to amortize over a period of time over the term of debentures. Amortization of ancillary cost incurred in connection with arrangement of borrowings at the time of taking the borrowing, at the time of sanctioning, or when the entire process of arrangement of borrowings is being conducted, there may be some type of ancillary cost, maybe filing cost or whatever type of cost is there, which have been incurred. So all these costs, interest and commitment charges on bank borrowings, amortization of discount of borrowings related to these borrowings, amortization of ancillary costs incurred in its connection, all these costs are covered as borrowing cost under the existing notified AS 16. But what about Ind AS 23? Ind AS 23 requires to calculate the interest expense using the effective interest method as described in Ind AS 109. So it gives the calculation of interest expense as not by the simple way, but by using the effective interest rate method, which has been described in Ind AS 109. So any entity has to apply this method and study the calculation, the procedure from Ind AS 109. Certain items therein have been deleted, as some of those components of borrowing cost are considered as a component of interest expense calculated using the effective interest rate method. So in our existing AS 16, we take the whole borrowing cost. We do not apply as such, we do not delete or we do not cut any portion of the amount incurred in borrowing arrangements. But under Ind AS 23, there are some deletions, some items, certain items therein which have been deleted as component of borrowing cost, and plus whatever items which are considered as component of interest expense, they are also calculated using the effective interest rate method. So this is very important difference. Explanation of substantial period of time. We all know what is substantial period of time as per AS 16. The definition is giving any qualifying asset to be called a qualifying asset. The asset to be completed or the item to be to make it ready for use, to make it ready for sale, it must take substantial period of time to complete. This explanation, the definition of substantial period of time, generally 12 months.
This is an explanation. Earlier it was an ASI, accounting standard interpretation, which has clarified on this terminology, substantial period of time. It is very subjective clause, depends on the entity and the situation. However, for generalization, they have said it could be more than 12 months. More than 12 months. And later on that ASI was added in the standard AS 16 as an explanation. However, this clarification or the clarification on this terminology, substantial period of time, is not continued or not there in Ind AS 23, though the terminology has been used, but that clarification is not there in Ind AS 23.
Ind AS 23 provides that when Ind AS 29, this is a fifth difference, reporting in hyperinflationary economies. Ind AS 23 provides that when Ind AS 29 financial reporting in hyperinflationary economies is applied, part of the borrowing cost that compensates for inflation. You all know that whenever we pay interest for debentures, whenever we pay interest on loans, there is some rate, there is some percentage which is generally being compensated for the inflation in the coming years. So there is a separate Ind AS 29 financial reporting in hyperinflationary economies. As per the terminology of Ind AS 23, it clearly provides that when Ind AS 29 is applied, part of the borrowing cost that compensates for inflation should be expensed as required by that standard and not capitalized in respect of the qualifying asset. What does it mean? It means that if a person is paying interest amounting to rupees 10,000 for debentures in a particular year, there must be, suppose I have taken a loan on 10% rate of interest. There is 6% may be time value for money, that means rate of interest in actual, and 4% may be a compensation for inflation which may occur in the coming years. So that amount of 10,000, out of that 10,000, only 6,000 is basically the portion of borrowing cost. The 4,000 amount of 4,000, which is basically compensating for the inflationary trends in the coming years, that should not be capitalized, that should not be considered as a borrowing cost related to be associated with that particular qualifying asset. But however, what Ind AS 23 specifies that 4,000 should be accounted as per Ind AS 29, not as per Ind AS 23. That amount should be bifurcated. However, our existing AS 16 does not contain any such clarification, because in India there is no notified standard on financial reporting in hyperinflationary economies. So whatever amount of, all the amount of 10,000, 10% rate of interest on debentures, or all amount of 10,000 will be capitalized in respect of a particular qualifying asset as per our existing AS 16. This is a major difference. Now, what about borrowing of the parent and its subsidiaries for computed weighted average? Ind AS 23 specifically provides that in some circumstances, not always, but in some circumstances, it is appropriate to include all borrowings of the parent and its subsidiaries when computing a weighted average of the borrowing cost. That means, at some points of time, it may be appropriate to include all borrowings, not only of the parent or not only of the subsidiaries, but all borrowings of the parent and the subsidiaries at the time of computing a weighted average of the borrowing cost. While in other circumstances, it may be appropriate for each subsidiary to use a weighted average of the borrowing cost applicable to its own borrowings. So, this is the provision which is provided under Ind AS 23, but such type of provision regarding inclusion of all the borrowings of the parent and the subsidiary while computing a weighted average is not given under existing AS 16. The Ind AS 23 also provides that in certain cases it may be appropriate for each subsidiary to use a weighted average of the borrowing cost applicable to its own borrowings also. That provision is also missing in our existing AS 16. Disclosure of capitalization rate. Ind AS 23 requires disclosure of capitalization rate. We all are familiar with capitalization rate, as we have already studied under existing standard also. Ind AS 23 requires disclosure of such rate, the rate at which you are capitalizing, that should be which has been used to determine the amount of borrowing cost eligible for capitalization. But our existing AS 16 does not have such disclosure requirement.
In this, I would like to add, as we all know, Ind AS have more transparent standards, and the transparency comes with disclosures, number of disclosures. So here in AS 16, the disclosure requirements as comparison to Ind AS are less. Are less in account. So that's why it is said existing standards, accounting standards, are not that transparent in comparison to Ind AS 23, sorry, Ind AS, which are said to be more transparent, and this transparency comes because of the number of disclosure requirements. Though usage of capitalization rate is both in AS 16 and in Ind AS 23, but that what is the rate which we are using is not required to be disclosed as per AS 16, though it is used there. But in Ind AS 23, they say whatever you are using, you have to disclose. You have to disclose the base of capitalization, so that a user of the financial statement, if wants to know or want to check it on their own, they can check it out, and that makes the financial statements based on Ind AS more transparent. Let's come to the queries. Functional currencies are the currencies in which the reporting, the economic, if an entity, the currency which is prevailing in the country or in the economic environment in which the entity is is doing their business. That is functional currency. Reporting currency is the presentational currency, and which an entity is presenting their financial statements. So this is the concept for functional currency, is the currency of the economic environment of the entity, where the entity is doing the business. What is the effect of liquor, which takes substantial period of time as per? What is the effect of liquor, which takes substantial period of time as per Ind AS 23? Okay, so see, liquor, definitely liquor takes its own time to get it matured. The different liquors take their different substantial period of time. So that substantial period of time is different. However, let me tell you, like for inventory, Ind AS is dealing with the inventory for borrowing cost, but for existing standards, we have separate standard on Ind AS inventory. So AS 16 does not deal with the inventory. Is it? Okay. So for liquor, substantial period of time, for reference of substantial period of time, in case of borrowing cost, you have to refer Ind AS, and for there it will be definitely nothing is mentioned or no clarification has been given for what is substantial period of time. So it's very subjective, depends on the entity and the other criteria. Like for in Ind AS 1, when nothing is mentioned in Ind AS 23, you have to refer Ind AS 1, presentation of financial statements, where classification is for current and non-current. So based on that classification for inventory, where operating cycle, you have to refer. For liquor also, you have to refer the operating cycle, which is there mentioned in the Ind AS 1. Okay. And last, students may note our email IDs and our contact numbers. In case of any query, they can call us and they can also mail us. We would like you, in case of technical queries, you can please mail us on our following mail IDs. And in case of general queries, on the latest publication. So please remember, your query should be confined to our latest publications of BOS material, whether it is study material, practice manual, compilation, or RTP or mock test papers or suggested answers. Please refer to the latest materials. In case of those latest materials, you are finding some difficulty or you have any query, you can mail us at seema@ici.in or shilpa@ici.in. For contact, you can call us on this number. Over the phone, we would prefer to take the general queries, but for technical queries, we would like to you to mail us on this query. In case you have any doubt on the standards which we have covered today, you can mail us and also call us. And hope you have taken the maximum benefit of our today's session. And all the best, and we'll hope you see our next sessions which are on for the other standards. Thank you.